Hi guys, Keelan from Horizon here. Thanks for taking the time to watch this short clip. Just over my shoulder here you may notice a rather just typical looking office building here, but it actually is the premises of none other than the Rothchild family. So Rothchild and Sons have their premises here right in the heart of London City. And what you may not know, and what I only recently found out, is that the price of gold is actually fixed twice daily in this very building by 5 members of the London gold market. It happens, I think, around 10 o'clock in the morning and also 3 o'clock in the afternoon, if I'm not mistaken. And what struck me was that gold is seen as a safe haven for investors, and in a way I suppose so is the London property market. But you have a kind of a two-tier property market over here. In the first tier you have the overseas, the wealthy, well-heeled overseas investors who are parking their cash in London and picking up trophy assets at the same time. And then you have the everyday investors, people like ourselves, who are looking to acquire cash-flowing assets. And in London that can be difficult to do, but it can be done. You may consider looking in areas such as southeast London and the outskirts. But I just wanted to say a little bit about our forum, which is happening next Tuesday the 6th. We're really looking forward to kicking off the Horizon Financial Forum and hope to see many of you there. It's going to be a very interesting evening with a great panel of experts covering areas such as commodities, stocks, the property market and tax. So listen, we hope to see you there, and in the meantime you may enjoy watching this clip. Thank you.
Hello and welcome to my morning note. Today we have for you what is known in the trade as some property porn. This house here in Hyde Park in central London is currently on sale for £300 million. That appears to me to make no sense at all. It implies that prime central London property is in a bubble, but then I'm not an expert. Today, however, we have with us a true expert on this subject to discuss London property. He's our property correspondent, Ed Hammond. Ed, thanks for coming on the video. Let's start with this, a very telling chart, all shown in dollars. The red line shows you Miami house prices since 1999, obviously part of a notorious bubble which subsequently burst. The blue line, valued in dollars, is the Econometrics index for Greater London. It looks as though we have a second bubble taking off before the first one has really collapsed. Is that a fair statement?
Well, it certainly looks that way. I mean, what's very interesting is that almost the entire uplift you see in this blue line from 2009 to now is being driven by the prime central London market. So actually, if you were to strip out perhaps the top sort of 5 or maybe even 2 or 3% of the market, this would actually probably flatline much more along the line that you see with Miami. So it is perhaps fair to say there's a bubble, but it's a bubble isolated really in just the very highest bit of the market.
Okay, and we can illustrate that with our next chart, which is drawn up by Fathom Consulting. If you see the green line for what they define as prime central London, which is about 8 postcodes, it does bear out exactly what you just said. It was not anything particularly special until the beginning of the credit crisis, and it's taken another big leg up since the Eurozone crisis. Yeah. What precisely do you think is driving prime London?
Well, it's a number of factors. So, as you say, the Eurozone crisis has sort of pulled it up even higher because you're seeing a lot of money coming in from Greece, from Italy, more recently from Spain. And this is basically people wanting to get their money out of those economies and put it into fixed assets in the UK where they think it's safe and it will hold its value. So it's really a haven investment. The other thing which you have, which is much more consistent, is money coming in from the Far East, particularly Hong Kong, Malaysia, China as well. And that is sort of just gradually pulling prime up and up and up and away, as you can see from these two markets, which are much more closely linked to the domestic buyers.
Okay, let's take another much more granular look. This is produced by HomeTrack. Each diamond here is a different postcode. Basically, the cheaper your house was in the first place, the more likely it was to have lost money since the peak. How is this sustainable? I mean, it just seems so socially unhealthy. It's only a year since we saw rioters invade a restaurant in Notting Hill. How can this dynamic possibly continue?
Well, it's absolutely right to say that. And as you started with this £300 million pound house, these are sort of levels that are completely unimaginable to most working people in this country. And indeed, as you see with this, some of the postcodes in London are just becoming completely unaffordable. I mean, the sort of average house price, I think, in Kensington and Chelsea passed £1 million this year for the very first time. You know, these are prices, as you say, that are just not supportable by domestic buyers. It has to continue this money coming in from overseas if those prices are going to be sustained.
And on the subject of money coming in from overseas, this is an extraordinary chart from Jones Lang LaSalle. Apparently only 19% of purchases of new central London developments are actually British. Take me through this. Can this really be true?
Well, this is absolutely fascinating, this chart. I mean, the first thing to say is that Jones Lang, because of the kind of work they do, are probably slightly more skewed to overseas buyers than other agents. But all the same, just the volume of overseas buyers coming into this market, and this isn't prime. This isn't these sort of £100 million houses in Kensington. This is your average sort of 2-bed family house, Barratt Homes, Berkeley Homes being built, new build in London. So this is really the core, what you would think of as the core market for domestic buyers. And as you can see, it's just being completely consumed by overseas money at the moment.
Well, half of it from just Hong Kong, Singapore and Malaysia.
Exactly, which is very interesting, because what developers are now doing is they're going to Hong Kong, they're going to Malaysia, and they're doing a lot of their marketing there before they even start the project. And what it means is that they can pre-sell hundreds of units, completely de-risk the construction, and then start building the project. And this is a market that has been very successful in the Far East. It's something they're much more comfortable with as buyers buying off-plan. UK buyers can't do that, can't borrow against that. So I think you're probably, if anything, going to see this side of the chart grow and the domestic buyers shrink.
Okay, Ed, thank you very much indeed. That's at least helped to explain why London property is behaving as bizarrely as it is. Plainly, there still are very many risks around if something horrible happens to various Southeast Asian economies, or if there are certain resolutions to the Eurozone crisis, these dynamics could change very quickly.